Something fundamental has shifted in the silver market, and most investors haven't noticed yet. We're not talking about price predictions or get-rich-quick schemes. We're talking about structural supply constraints that haven't been seen in modern commodity markets. According to industry data compiled by major mining research firms, global silver mine production is projected to remain below 2016 levels through the end of this decade. Let that sink in for a moment. We're looking at nearly 15 years of flat to declining primary production in a metal that's simultaneously a monetary asset and an industrial commodity. This isn't speculation. These are projections based on existing mine reserves, development timelines, and the geological reality of what's currently in the ground. If you hold silver right now, you need to understand what this supply dynamic means for your position. If you're watching from the sidelines, you need to understand why this moment is different from the typical commodity cycle. And if you're dismissing this as just another commodity story, you're missing a convergence of factors that rarely align this clearly. This isn't about hype. It's about understanding structural change in real time before the broader market fully prices it in. Let's walk through this calmly, methodically, and with the discipline that serious investors bring to every decision. Here's what we know from mining industry reports and geological surveys. Global silver mine production peaked in 2016 at roughly 900 million ounces. Since then, output has declined or stagnated, and the forward-looking data tells us this trend continues. Major research firms tracking mine development pipelines show insufficient new projects coming online to replace depleting reserves. Why does this matter? Because unlike above-ground financial assets that can be created at will, physical commodities require years of exploration, permitting, development, and production ramp-up. The silver that would be mined in 2028 requires decisions and investments that should have been made years ago. Those investments largely didn't happen. After silver's volatility in the early 2010s, capital allocation shifted away from primary silver development. Many mining companies focused on gold or base metals with more predictable demand profiles. Environmental regulations tightened globally, extending permitting timelines. And the marginal grades of new discoveries declined, meaning more ore must be processed for less silver. The result is a pipeline problem. Even if mining companies wanted to dramatically increase silver production tomorrow, the geological and operational reality is that it takes 7 to 10 years to bring a major new mine online. The silver market of 2030 is largely determined by decisions already made or not made. This is what structural constraint looks like. It's not a temporary disruption. It's not a labor strike or a geopolitical event that resolves in months. It's the slow-moving reality of resource depletion meeting underinvestment. Now, let's look at what's happening on the other side of the equation. Silver demand isn't static. It's not even declining. In fact, industrial demand for silver continues to grow, driven by applications that didn't exist or were minimal a decade ago. Solar panel manufacturing alone now consumes over 100 million ounces annually, and solar installation targets globally suggest this number will increase significantly by 2030. Electric vehicles require more silver per unit than traditional automobiles. 5G infrastructure requires silver. Medical applications continue expanding. The industrial use case for silver isn't discretionary luxury consumption that disappears in a downturn. It's embedded in the infrastructure of modern technology and the global energy transition. At the same time, investment demand for physical silver remains robust. This is where monetary concerns intersect with industrial fundamentals. When investors lose confidence in currency stability or financial system resilience, they historically move toward tangible assets. Silver, along with gold, represents stored value that exists outside the banking system. We're seeing this dynamic play out in real time. Central banks globally have expanded balance sheets to levels that would have been unthinkable 20 years ago. Government debt to GDP ratios in developed economies have crossed thresholds that historically preceded monetary instability. And inflation, after years of being dismissed as transitory or dead, has demonstrated it can return with force. This creates a psychological shift among certain investor classes. When the stability of financial assets feels less certain, the appeal of physical assets increases. Silver sits at the intersection of this monetary concern and industrial necessity. That's a rare position for any commodity. The typical investor thinks of commodities as cyclical and mean reverting. Prices go up, production increases, prices come back down. This mental model works most of the time, but it breaks down when you hit geological constraints, or when the time lag between price signal and supply response becomes too long. We saw this with oil in the mid-2000s, we saw it with copper in various cycles, and we're seeing it now with silver, except silver has the added dimension of monetary demand that doesn't respond to industrial price signals. Most people also misunderstand the relationship between above-ground stocks and annual production. Yes, there's existing silver inventory in various forms, from institutional holdings to jewelry to industrial stockpiles. But that inventory tends to be sticky. It doesn't freely flow back into the market just because prices rise. The family silver passed down through generations doesn't get melted when prices double. The silver in existing solar panels doesn't get recovered until those panels reach end of life 25 years later. The silver held by long-term investors isn't necessarily for sale at any price because they're holding it as insurance against currency devaluation, not as a trading position. This means the effective available supply is much smaller than the total above-ground stock suggests. In periods of supply deficit, this matters enormously. The market can't simply call on existing inventory to close the gap if that inventory isn't truly available. Another critical misunderstanding is the gold to silver ratio. Many investors watch this ratio, expecting it to revert to historical averages, but ratios only tell you relative value, not absolute value. Both metals can rise while the ratio stays wide, or both can fall while the ratio narrows. The ratio is a tool, not a crystal ball. What matters more is understanding the fundamental case for each metal independently, then using the ratio as one of many inputs. Right now, silver's fundamental case rests on supply constraint meeting persistent demand, while its monetary properties provide a secondary support. That's a stronger foundation than ratio watching alone. Let's look at how markets have behaved during previous supply-constrained environments. In the 1970s, silver moved from roughly $1.50 per ounce to nearly $50 during the peak of the Hunt brothers' accumulation, driven by a combination of inflation fears, monetary instability, and concentrated buying. That peak was unsustainable and driven by market manipulation, but the underlying decade-long trend reflected genuine currency concerns and supply-demand imbalances. In the late 2000s and early 2010s, silver rose from $8 to nearly $50 again, as the financial crisis destroyed confidence in the banking system, and central banks began unprecedented monetary expansion. That rally, too, overshot and corrected sharply, but the foundational concern about currency debasement remained valid. What both periods demonstrated is that silver can move dramatically when monetary confidence erodes and physical demand intersects with constrained supply. They also demonstrated that volatile moves attract speculation, which can create unsustainable peaks followed by painful corrections. The lesson isn't that silver always goes up. The lesson is that silver behaves differently when monetary stability is questioned and when physical availability becomes tight. We're now entering a period where both conditions may persist simultaneously for years, not months. Historical patterns also teach us about market psychology. In the early stages of a supply-constrained commodity market, prices rise gradually as fundamental buyers recognize the situation. Most investors ignore this phase, dismissing it as normal volatility. Then, as the reality becomes undeniable and prices accelerate, momentum buyers enter, followed eventually by speculators and those driven by fear of missing out. The disciplined investor wants to understand the fundamental case early, position appropriately, and then manage the emotional roller coaster that comes when markets overshoot in both directions. The challenge isn't identifying that something meaningful is happening. The challenge is maintaining composure when everyone around you is either panicking or euphoric. We can't discuss silver's supply situation in isolation from the broader economic environment. Global debt levels, both public and private, have reached points where traditional deleveraging through growth or austerity seems increasingly unlikely. That leaves monetary solutions, which historically means some combination of inflation, financial repression, or currency devaluation. None of these outcomes are positive for holders of cash or fixed income assets denominated in depreciating currencies. Interest rates, despite recent increases, remain historically low in real terms when adjusted for actual inflation. This creates a hidden tax on savers and a distortion in capital allocation. When real rates are negative, the opportunity cost of holding non-yielding assets like physical silver diminishes significantly. We're also seeing a gradual loss of faith in the stability of the international monetary system. The dollar's role as global reserve currency faces challenges it hasn't encountered since the Bretton Woods era. Whether those challenges result in displacement or simply diversification, the implication is the same: a search for alternative stores of value. This is where silver's dual nature becomes fascinating. It's not just an industrial metal. It's not just a monetary metal. It's both simultaneously. This means it benefits from industrial growth trends like electrification and renewable energy, while also serving as insurance against monetary instability. The macroeconomic environment we're entering rewards assets that are scarce, tangible, and outside the control of central banks or governments. Silver fits that description. Gold does too, but silver's smaller market size means it can move more dramatically in both directions. Understanding these macro forces isn't about predicting exact outcomes. It's about recognizing which direction the probabilities are tilting and positioning accordingly. The probability of significant inflation over the next decade is higher than the probability of sustained deflation. The probability of currency instability is higher than the probability of dollar strengthening. These aren't certainties, but they inform rational positioning. If you already own physical silver, here's what this supply dynamic means for your position. First, understand that you're holding an asset whose supply is becoming structurally constrained while demand remains persistent. This is the fundamental case for patience. The market doesn't price in slow-moving supply changes instantly. It takes time for the broader investment community to recognize and act on fundamental shifts. Your challenge isn't about timing the next trade. It's about maintaining conviction during volatility. Silver will have down days, down weeks, down months. The spot price will frustrate you. You'll read bearish commentary questioning the entire thesis. This is normal and unavoidable. What matters is whether the fundamental case remains intact. If mine production continues tracking below 2016 levels, if industrial demand continues growing, if monetary instability continues simmering, then temporary price weakness is noise, not signal. The disciplined holder uses weakness to potentially add to positions, not to panic and sell. Second, recognize the difference between holding physical metal and holding paper proxies. Physical silver in your possession is actual exposure to the supply constraint we're discussing. ETFs, mining stocks, and futures contracts are different instruments with different risk profiles. They have their place in a portfolio, but they're not equivalent to physical possession. If you're holding for monetary insurance reasons, physical metal is the only true hedge. If you're holding for price appreciation speculation, paper instruments may offer more liquidity and leverage. Know which category you're in and why. Third, resist the temptation to overtrade your position. Every time you sell physical metal, you incur transaction costs through spreads and premiums. Every time you buy it back, you pay those costs again. This constant trading destroys returns, especially in a tax-inefficient manner. The strongest hands in commodity markets are those who understand their thesis, size their position appropriately, and then simply hold through volatility. This is harder than it sounds because our brains are wired to react to losses more strongly than gains. But it's the behavior that historically produces the best long-term outcomes. If you don't currently hold silver and you're evaluating whether this supply constraint matters enough to warrant a position, here's how to think about it. Start with your overall financial situation. Do you have stable income? Are high-interest debts paid off? Do you have adequate emergency savings in liquid form? Physical commodities are not a substitute for financial stability. They're a component of a diversified strategy for wealth preservation and growth. If your financial foundation is solid, then the question becomes allocation. What percentage of your investable assets makes sense to dedicate to hard assets like silver? For most people, this number is somewhere between 5% and 20%, depending on risk tolerance, time horizon, and views on monetary stability. A smaller allocation allows you to benefit if the supply constraint thesis plays out without taking excessive risk if it doesn't. A larger allocation signals a stronger conviction about currency instability and industrial demand growth. Neither is inherently right or wrong. It depends on your circumstances and beliefs. Timing is the question everyone obsesses over, but it's often the least important factor for long-term holders. If you believe the fundamental case for structural supply constraint and persistent demand, then starting a position at current levels and potentially averaging in over time is more important than trying to perfectly time the entry. Yes, silver could be cheaper next month or next quarter. It could also be significantly higher. The volatility works both ways. What you're trying to avoid is the psychological trap of waiting for the perfect entry point and then either never entering or panic buying at much higher prices after a dramatic move. Consider building a position methodically. Perhaps allocate a certain percentage this month, another portion in 3 months, and so on. This removes the emotional burden of trying to time a single perfect entry and ensures you're participating in the fundamental story as it unfolds. Also, educate yourself about physical silver ownership logistics. Premiums over spot price vary by product and dealer. Storage has costs if you're holding significant amounts. Security considerations matter. These practical details aren't glamorous, but they're part of responsible ownership. Let's be very clear about behaviors that destroy capital in commodity markets. Do not over-leverage. Using excessive margin or debt to buy silver is a fast track to getting liquidated during inevitable volatility. Even if the long-term thesis is correct, leverage can force you out of your position at the worst possible time. Physical silver ownership is about preservation and patient appreciation, not gambling. Do not chase momentum. If silver suddenly jumps 20% in a week, that's not the time to panic and buy aggressively. Rapid moves attract reversals. The time to accumulate is during quiet periods when nobody's paying attention, not during euphoric rallies when everyone suddenly becomes an expert. Do not neglect the rest of your financial life. Some people become so convinced of a single thesis that they allocate irresponsibly, ignoring diversification, ignoring income-producing assets, ignoring basic emergency savings. This is dangerous, regardless of how compelling the silver supply story is. Do not confuse price volatility with thesis invalidation. Silver will have bad days. It will have bad months. Short-term price action is dominated by technical trading, derivative positioning, and sentiment shifts that have nothing to do with physical supply and demand. If you react emotionally to every price swing, you'll make terrible decisions. Do not follow online hype blindly. There are many voices in the precious metals space, some credible, some not. Some promote silver responsibly with data and analysis. Others use fear-mongering and price predictions to drive engagement. Learn to distinguish between educational content and marketing. Do not ignore tax implications. In many jurisdictions, physical precious metals are taxed as collectibles with higher capital gains rates. Understand the tax treatment in your location before accumulating a large position. Surprises at tax time can turn profitable investments into frustrating ones. Do not treat silver ownership as religion. Some holders become emotionally attached to their positions, unable to objectively assess whether the thesis remains valid. Stay flexible. If the fundamental case changes, if massive new supply comes online, if industrial demand collapses, be willing to reassess. Conviction is good. Dogma is dangerous. Every investment carries risk. Understanding those risks is how you avoid catastrophic outcomes. The primary risk to the silver supply constraint thesis is technological substitution. If engineers develop cost-effective alternatives to silver in major applications like solar panels, industrial demand could decline faster than expected. This is possible, but unlikely in the near term given silver's unique properties and the embedded infrastructure designed around it. Another risk is economic depression severe enough to crush industrial demand. If global manufacturing collapses, silver's industrial use case weakens significantly. However, in such scenarios, the monetary properties of silver might offset some industrial weakness as investors flee financial assets. There's also the risk of above-ground supply becoming more available than expected. If recycling rates increase dramatically, or if previously unavailable inventory enters the market, the supply constraint loosens. This is a legitimate consideration, though recycling infrastructure changes slowly and inventory holders have been generally sticky. Regulatory risk exists as well. Governments facing fiscal pressure have historically considered or implemented restrictions on precious metals ownership. While unlikely in most developed markets today, it's not impossible if monetary crises worsen. Diversifying storage locations and understanding legal frameworks can mitigate this risk. Market manipulation and intervention risk is real in smaller markets like silver. Large traders or institutions can influence prices through derivative markets in ways that don't reflect physical fundamentals. This creates volatility and can shake out weak hands, but it doesn't change the underlying physical supply-demand balance. The proper way to manage these risks is through position sizing, diversification, and emotional discipline. Don't bet everything on one thesis. Don't assume anything is certain. Hold silver as part of a broader strategy that includes other asset classes, other commodities, other forms of wealth preservation. Let's step back and look at the broader context of what's happening. We're living through a period of monetary experimentation unprecedented in modern history. Central banks are navigating territory without clear maps or historical precedent. The consequences won't be clear for years or decades. In this environment, holding assets that are tangible, scarce, and useful provides a form of insurance that financial assets alone cannot. Silver represents one piece of that insurance, not because it's guaranteed to appreciate, but because it possesses properties that financial assets lack. The supply constraint we're discussing is real, but it's slow-moving. This isn't a 6-month trading opportunity. It's a structural shift that could take years to fully play out in price. The investors who benefit most will be those who position early, size appropriately, and then simply hold with patience. This requires a different mindset than most market participants possess. It requires ignoring daily noise while staying informed about fundamental developments. It requires comfort with volatility and paper losses. It requires conviction without arrogance, patience without complacency. The silver market is small enough that when large capital does recognize the supply-demand imbalance, prices can move quickly and dramatically. But that recognition could happen next month or 3 years from now. Nobody knows the exact timing. What we do know is that mine production is constrained, industrial demand is growing, and monetary instability persists. Understanding structural supply constraints in commodity markets is a valuable skill that applies far beyond silver. Whether you choose to hold silver or not, the lesson here is about recognizing slow-moving fundamental changes before they're fully priced into markets. It's about distinguishing between noise and signal. It's about having the discipline to act on conviction while managing risk responsibly. For those who already hold silver, stay informed about production data, demand trends, and monetary developments. Revisit your thesis periodically to ensure it remains valid. Ignore short-term price volatility and maintain focus on the structural story. For those considering a position, take time to educate yourself thoroughly. Understand what you're buying and why. Size your position appropriately, and then be patient enough to let the fundamental case play out over years, not months. The silver market doesn't care about your entry point or your exit target. It will do what supply, demand, and monetary forces dictate over time. Your job is to understand those forces, position accordingly, and maintain the emotional composure to stay the course when others are panicking or euphoric. This is how thoughtful investors approach every decision, not with certainty or predictions, but with probability-based thinking, risk management, and the humility to know that markets are complex and outcomes are never guaranteed. The supply constraint in silver mining is real. Whether it translates into significant price appreciation depends on variables nobody can predict with certainty. What you can control is your preparation, your education, and your emotional discipline. Stay informed, stay balanced. And remember that understanding market cycles and structural changes is more valuable than any single trade or position. The investors who do best over decades aren't the ones who perfectly time markets. They're the ones who understand fundamental value, position appropriately, and have the patience to hold through volatility. That's the opportunity in front of you now. Not a get-rich scheme, not a guaranteed outcome, but a structural shift worth understanding and potentially participating in with the right mindset and approach. Thank you for watching. Continue your education, think independently, and make decisions that align with your personal financial situation and goals. The best investment you can make is in your own understanding